Good day, ladies and gentlemen, and welcome to the Whittier Trust Investment and Market Outlook conference call. All lines have been placed on a listen-only mode. At any time during the webinar, you may ask a question at the bottom left-hand side of your screen. At this time, it is my pleasure to turn the floor over to your host, David Dole. Sir, the floor is yours.
Well, good morning, and thank you for joining us today for Whittier's Actionable Ideas Investment and Market Outlook. We are certainly living in a world of flux. The world is changing, and it's impacting our health, our families, and our wealth. At Whittier, we remain proactive and engaged. We are committed to our clients, their families, and their employees. I am proud of our team and the pivot we are making to webinars. Whittier's multifamily office and holistic approach is bringing stability, reliability, and confidence to our clients. Video conference calls are a new normal, allowing us direct and face-to-face contact. I want you to know that I'm personally available to you anytime. As we look forward and plan for the future, we know that business will be conducted differently, and this will impact revenue, income, and valuations for stocks, real estate, bonds, and basically all asset classes. Today, Sandip Bhagat, Whittier's Chief Investment Officer, will share with you our outlook on the economy and financial markets. At the end of his comments, Sandip will take questions. My thanks to all of you for joining with us, and Sandip, I turn the floor to you.
Thanks, David. Good morning to all of you. Welcome. I'm Sandip Bhagat. I'm personally delighted that you have joined us today. As David mentioned, we live in interesting times. The coronavirus pandemic has swept across the globe in a way that few would have predicted. It has taken a toll in so many ways, it's hard to even describe. Where would I begin if I wanted to? Well, it has infected over 1.8 million people in over 180 different countries. It has inflicted significant human pain and suffering. It has strained healthcare systems all around the world. It has single-handedly delivered the single largest economic shock that we have ever seen, and it has unleashed unprecedented volatility in the markets. But the last few weeks have offered some welcome relief. Stock prices have rebounded, volatility has subsided, and on an encouraging note, policy responses to the crisis so far have also been unprecedented. They've been swift, they've been decisive, they've been aggressive. The eventual impact of coronavirus will depend on the progress that we make on medical and economic fronts, and our main discussion points today specifically evaluate progress on both of these fronts. So we know social distancing and shutdowns are effective mitigation tools from a health perspective, but they take an inevitable toll on the economy. We will measure success on the medical front, but as we do so, we will also look at the prospects of flattening the downward sloping economic curve. How bad is the damage now? Can it be contained going forward? In the near term, we look ahead to the restart of the economy and what a recovery might look like over the longer term. We remain bullish on the U.S. economy and markets, and we conclude with portfolio insights, not only for a crisis like this, but also for long-term wealth transfer. Let's discuss each of these in greater detail. We have a lot of ground to cover, so sit back, relax, and listen to all this as you might to an anecdote. If my remarks trigger a question in your mind, as Kat mentioned, be sure to send it along to us. Please type the question into the box at the bottom of the Q&A window, and my colleague T. Sanders will add them to his list. So, what progress have we made on flattening the health curve? The good news is we have actually come a long way in containing the virus. The left chart on slide 4 shows the global damage. Over 1.8 million cases and almost 115,000 deaths. These two numbers together produce a crude fatality rate, it's shown on the right chart, of just above 6%. This mortality rate is likely overstated right now, just for lack of broad testing. The light blue line on this right chart tracks the growth in cases on a weekly basis. Now, this metric of congestion actually peaked way back in early March, and this is a touch misleading. That surprisingly early peak actually comes from simply the arithmetic of growth rates. We know changes in small initial numbers can produce high growth rates. So let's just focus on the total number of cases. Has that curve started to flatten? And the answer on the next slide is a resounding yes. Now, this is a really busy slide, so where can I draw your attention? Let's take a look first at Italy. Look for it somewhere near the top right. Italy emerged as the main epicenter in Europe. It went through a first-in, first-out sequence with the virus. In Italy, daily new cases peaked on March 21. Daily deaths peaked in Italy on March 27. Okay, I'll repeat the dates again. Those two dates were March 21 and March 27. And now, suddenly, it is no surprise that the S&P 500 bottomed out right around then on March 23rd. The United States has always been a couple of weeks behind Italy. The red curve is for the U.S. It's right at the top. That has started to flatten. But let me come back to you with an update on U.S. in just a moment. I do want to talk about really the most remarkable growth curve here. It's South Korea. It's right in the middle. Let me make some interesting comparisons. Both the U.S. and South Korea saw their first coronavirus case on January 20. By April 3rd, the U.S. had almost 250,000 cases, 6,000 deaths, and 10 million unemployed workers. On the other hand, South Korea had less than 10,000 cases, fewer than 200 deaths, not a single city in full shutdown, and just a few job losses. How did this happen? This was all from mass testing, tracking, and isolating cases and contacts. It's a remarkable success story, and I hold it out because it could be a marker for us as we look ahead. So let's come back to the U.S. And in many ways, as goes New York, so does the rest of our country. New York has been the epicenter in the U.S. 1/3 of the almost 600,000 cases in the U.S. have come from New York, and sadly, so have almost 40% of the deaths. But we do see a silver lining in the dark cloud hanging over New York. So what do we have here? The chart at the top shows new hospitalizations. They peaked back on March 26. New ICU admissions are shown in the lower chart. They peaked on April 4. Deaths in New York are projected to peak just about any day now. The rest of the country will follow these trends. Deaths are projected to peak around the country in the next couple of weeks, so we seem to be on track towards flattening the health curve, reaching the apex, and being able to look at the downward trajectory on the other side as cases subside. We can now, therefore, start to think about a restart. And in such restart, what medical breakthroughs might help us make it as seamless and smooth as possible? Spend a couple of minutes looking at that quickly. I'll do something unusual. I'm going to read this slide backwards from right to left. So, of course, the biggest medical breakthrough going forward will obviously be a vaccine. But we know it won't be easy. The most optimistic initial timeline for a vaccine was 12 to 18 months. The pace of research is intense on this front. There are over 70 coronavirus vaccines under development globally. As you can see here, 6 of them are already in human clinical trials. The furthest along is a Hong Kong firm. They received approval to start human trials about a month ago. Here is something new and startling. A team in the UK, led by Oxford scientists, claimed over the weekend, 2 days ago, that a vaccine could be ready by September. Well, wouldn't that be great? The next avenue of hope is to instead find some effective treatments for the virus. This could come in the form of antiviral or antibody drugs. What's the difference? Antiviral drugs essentially inhibit the replication of the virus. There is one drug that seems to be furthest along. It is remdesivir from Gilead scientists. I knew that was a tongue twister. I'm glad I got over that. Early use of this drug holds out some promise. It's at least slowing the virus down. Antibody drugs and therapies, on the other hand, are used directly to fight the infection. Let me give you 2 quick examples. There is something called convalescent plasma. It's a theory where blood plasma from recovered patients is injected into sick patients. These antibody drugs can also be made synthetically. They will all work to fight the infection. There are 43 such treatments in human clinical trials. The company that developed antibody drugs for Ebola and MERS, Regeneron, is targeting trials in the summer. The final avenue is improved diagnostics. Abbott can now test a positive case in 5 minutes, a negative one in 13. With more accurate and scalable testing, we can now deploy the techniques that Asia has used so well. Test, track, screen, isolate. Will a few of these possibilities actually work? Will any of them work? And so here I have a confession. I am no medical expert. I reasonably should have no view on the topic, but I actually do. And let me tell you what I think. I am bullish on human ingenuity and creativity and innovation. I am optimistic that the human race will rise and conquer this challenge. So to me, it is not a question of if, it is just a question of when. So there you go. I'm leaving you with reason to be optimistic on the health front. But what about that downward sloping economic curve? Can we flatten that out and make it bottom out sometime soon? I'm going to come up with yet one more reminder. If anything I've said so far prompted a question, be sure to send it. Again, it's the box at the bottom of the Q&A window. So let's first start by looking exactly at how much economic damage has been created. So we have a few charts here that are quick, short, brief, but just interesting, right? And these are timely. They can be updated in real time. I'm going to start from the top left, go in clockwise manner. So the first one says hotel occupancy is closer to 20% instead of its more normal seasonal level of 70%. We slide over to the right, look at global flights. Air travel globally has fallen by more than 60% from the end of January. U.S. air travel, by the way, is down 90%. The chart at the bottom shows that rush hour traffic has fallen by more than 30% in San Francisco, Seattle, and New York. But the biggest shock to the U.S. economy has come from job losses. And the chart on the left shows weekly unemployment claims from 1980, and you see that big, massive vertical spike at the far right. That data point takes us to almost 7 million unemployment claims in a single week. It dwarfs all prior numbers. It far exceeds the previous high of 65,000 during the Great Recession. The chart on the right simply hones in on the last 12 months, and it shows the last 3 weeks in greater detail. And back to back to back, we have had high unemployment claims, above 3 million, above 6 million, and yet again over 6 million for the last week. That's over 16 million lost jobs, 10% of the workforce in 3 short weeks. And we know that this is a precursor to more widespread economic damage. Why do we say that? Well, quite simply because unemployment claims are positively related to GDP growth. We show that here, changes in quarterly unemployment claims move in tandem with changes in real GDP. So how badly will this increase in unemployment claims affect second quarter GDP? Well, put those seatbelts on. We're heading to an answer that at least is startling. So I'm going to ask you to do this. Take a quick look at the scale of the y-axis on both sides. There is a left y-axis, a right one. And if you project unemployment claims may have risen by 25%, then GDP would fall by minus 10%. I'm just linking the two numbers at the bottom of each of those y-axes. 25% in unemployment claims means GDP falls by minus 10. But that gold line showing unemployment claims at the right, it's actually truncated. The increase wasn't 25%. It was way beyond that. How far ahead of how big was that number? Well, it was so big that real GDP in the second quarter may decline by as much as minus 25 to minus 50%. That is a big number. I'm going to give you a couple of minutes to internalize that coming reality. In the meantime, I'll keep, as you reflect on it, I'm going to share a couple of really quick observations to help us understand where and how these jobs are being lost. So here, this is now my slide 12. That's what you should all be looking at. We show job growth here by the size of the firm. The green line shows how jobs have evolved at large firms. Excuse me, I realize I have to speak for a long time, so bear with me as I clear my throat. It's not the dry cough from COVID. It's just from speaking loudly and quickly. A large firm here are those with more than 500 employees. The blue line shows job growth and losses at small firms. Small firms employ less than 500 people. So in the early going of the recession, just focus on the far right, more jobs have been lost at smaller firms. Job losses at bigger firms so far have been more muted, which actually is good news, because if the stimulus package can keep small businesses afloat, and if the shutdown is relatively short-lived, we have a shot at reversing a large portion of the damage in the job market. Here's a different cut at the composition of job growth in the last 10 years. What are we looking at here? So first look at the big blob of red. Those are high-wage jobs. High-wage jobs are shown in red on this chart, and I'm going to follow how that red line has gone up and the very top of the chart all the way from 2010 to the end of 2019. And what you find is 65% of new jobs, so a full 13 million out of 20 million, have been created in high-wage occupations. And this segment has also seen the fewest job losses so far. The purple line of low-wage occupations, you'll see this at the far right, has fallen far more sharply than the blue medium-wage line or the red high-wage line. And from an economic perspective, the human tragedy aside, this trend is also encouraging. It preserves more disposable income in the system and potentially promotes greater consumer spending. So, with a glimpse at all of these economic conditions and the damage inflicted so far, the question we were asking is, how close are we to bottoming out on the downward economic curve? In many ways, this is really tantamount to asking how deep and long the coming recession will be. So before we proceed further, let's quickly recalibrate. What just happened? We have an economic shock from the pandemic that is unprecedented. We have seen a disruption to both supply and demand at the same time. We have seen a global sudden stop, and a number of industries and businesses globally have seen revenues decline by almost 100% overnight. So, before we even take a granular look at this, the big picture assessment is a global recession was a foregone conclusion about a month ago. The only question that remained at that time was how bad would it be? And let's quickly try to understand that. And what I did here was show you the broad range of economic forecasts that have been put out first for the second quarter of 2020 and then the full calendar year. And there are a bunch of numbers. I'm going to draw your attention to two sets of numbers that I think each tell a different storyline. So the first one is bolded for you. It's the median forecast, which says 22% decline in the second quarter, 3% decline in real GDP growth for full year 2020. I am going to suggest that these forecasts actually are more aligned with a more optimistic scenario of a V-shaped recovery. A sharp recession down in Q2, but short-lived, allowing for the recovery to happen as early as Q3 or Q4. There is another set of numbers so dramatic that they almost look like typos. Look for the row that says the low estimates. And you see numbers here like minus 65%, minus 10.8% for the full year. By the way, that 65 number is the GDP decline in a single quarter, the second quarter, but on an annualized basis. So that might feel you just a little bit better. But the takeaway is anything resembling this set of numbers is suggesting now that a recession may be longer and deeper, not to create the V shape, but perhaps to flirt or evolve around the lines of a U shape or even a W shape. Now, what has been going on in the background? Policymakers, I mentioned this before, have stepped up remarkably, swiftly, aggressively, and they have contained the economic fallout. So let us not lose sight of a third possibility that is probably not on the table now, but was very much around a month ago, where absent policy action or an actual mistake by a policymaker, there was a chance that this recession could have become a new great credit crisis. It could have become something like or worse than the Great Recession, or even become a Great Depression. I won't spend time on it. That possibility is extremely remote at this point. Now, which of these two paths of the recovery might evolve depends on the future impact of the virus and what more policy responses are designed to counter that impact. I'll give you a perspective on which of the two is more likely. In the meantime, since I brought up the topic of the policymakers, let's digress. We really must look at what these policy responses have been and what a magnificent job has been done on the fiscal and monetary stimulus side. So this is my kudos to policymakers. I'm going to start with fiscal stimulus first. So this is a mouthful, right? We passed the most recent package. We are going to call it the Coronavirus Aid, Relief and Economic Security Act. I'm lazy. I'm just going to call this the CARES Act from this point on. This provided fiscal stimulus to the tune of $2.3 trillion. $2.3 trillion is almost 11% of the U.S. GDP. This was the third such package announced by the U.S. government. A fourth one is already being discussed. And what will CARES go out and accomplish? What is it going to provide? Well, like a benevolent benefactor, this has something in it for everyone. So let's count this down. It looks suspiciously like I'm reading it, but the list is long. There are one-time stimulus checks for individuals, There are enhanced unemployment benefits. There will be loans to distressed businesses. There is small business relief. There is direct aid to state and municipal governments. There is health-related spending for the hospitals. And as the U.S. government is delivering this type of fiscal stimulus, they are not alone. This is happening all around the world. Germany's fiscal stimulus is almost 20% of its GDP, which is nearly double the U.S. package in percentage terms. The government is not acting in isolation. This is not simply about fiscal stimulus. There has been massive monetary stimulus, before I get to which, for those who are concerned that deficit spending could throw the fiscal budget, the federal budget, completely out of whack, I wanted to quantify that the near-term impact will, of course, be to take the deficit to be a big percentage of the budget, over 13%. But look at the evolution over the next decade, 10 years out, through its effect on growth, its revival, and the speed of that revival. Government receipts should increase, improving the budget picture, where a full 10 years out, we really should be no different than where the CBO, the Congressional Budget Office, was projecting us to be, right at minus 5.5% federal and fiscal deficit. So I was a little premature in going to the Fed. I want to do them full justice. My overarching comments are they have done an absolutely magnificent job. What have they done? They've just kept injecting liquidity into the system. How much liquidity? We'll see that in a few minutes. Let's say unprecedented. I might set a record for saying the word unprecedented in this webinar. But what the Fed has done has allowed the smooth functioning of markets, and you can see here through a couple of elements, it has also made credit available into the real economy. Now, the Fed had a good starting point. There was a playbook from the global financial crisis. They were able to dust it off, and it did prove very handy in this crisis. And what we thought might be interesting to you was just to compare what they have done this time around versus what they have done in the past. And so where would I pick this up? Like the last time, this time around, they cut rates to zero. They expanded FX swap lines. They created lending facilities to provide liquidity to dealers, the commercial paper market, money market funds, asset-backed securities. That's the commonality. Unlike last time, their asset purchases this time will include corporate credit, municipal bonds. They are even buying high-yield bond ETFs. Their lending facilities would extend to small businesses. So additional firepower here. And on the QE front, my goodness, they've come up with a program of asset purchases that has no limits. And just to make the quick comparison, their asset purchases, their QE in the first month here, exceeds what they did in the first 3 months back then. Their balance sheet is expected to expand by $5 trillion in the first 1 year here. Previously, it took them 6 years to grow it by $4 trillion. I spoke about the Fed a lot, so I'm going to absolutely fly through this slide. It's the same Fed policy action shown visually. On the left, you saw the remarkable decline to zero interest rates in just about a week. On the right side, you see the Fed balance sheet going up. It's gone up by $2 trillion from a starting point of 4 to a current level of 6, and it is widely expected that it will go as high as 8 to 10 trillion. And just as the Fed is doing that here, so are central banks all around the world. Global central banks have announced their own new QE and lending facility programs. That is to the tune of $2.5 trillion. And in terms of rate cuts, global short rates have declined by over 110 basis points with over 150 central bank rate cuts. What effect is all this having? Very, very quickly, what would we look at? We could look at something called the Financial Stress Index, which shot up, is reversing. It's below the recent high, but it's above the pre-crisis level. It's having some effect, but not fully so. Where are high-yield credit spreads? The same story. They spiked up. There has been some improvement, nowhere close to where they were 2 months ago. And at these levels, high-yield credit spreads are simply reflecting the higher default risk, which is likely from slower growth, lower demand, and lower cash flows. So to summarize, the health curve may have flattened, but there are no imminent signs that economic conditions are about to trough anytime soon. So what I thought we would do is take a quick peek at what the restart would be. Let's look ahead and start becoming constructive. This was kind of a recap of where we are, and here is how we see some aspects of the restart and the ensuing recovery. So we know the coronavirus pandemic has taken a heavy toll already. It's done it at many levels, medically, economically, financially, psychologically. And the actual loss of jobs during a recession inevitably creates uncertainty even for those who remain employed. And what happens because of that? At least historically, greater uncertainty during a recession tends to inhibit spending and leads to a greater propensity to save. And we see that on this chart. After both the Great Depression and the Great Recession, savings rate went up, and outgrowth of that is spending may decline. And so we leave you with the thought that if the pandemic proves to be a big generation-defining moment, we may see a meaningful difference in consumer behavior that downshifts spending. We have actually the only available data point by way of historical precedent. China went through a pandemic and is attempting to recover. We thought we would reproduce their timeline. The big solid line shows their growth in new cases. Look at the far right, incredibly busy slide without the ability to differentiate colors. I'm going to call the box at the far right a cross between yellow and green. I'm going with lime green. It highlights day 75, and the narrative in that box says 75 days later, after a lockdown was instituted, consumer spending had rebounded in China by 50%. So we hold that out as one possible path for U.S. consumer spending. Let me look through the restart and the recovery with a quick look at the U.S. stock market. And what do we see here? We see that the S&P 500, going from left to right, peaked on February 19th at a forward PE of 19 times. Prices have declined from that recent high. If you just recompute a forward PE based on consensus estimates, it now is measured at below 17. So for a moment, we might get excited that valuations have come down. They're either neutral, maybe they're attractive, but there is a caveat. This is a misleading measurement. Earnings estimates have come down a little bit, but not fully, because neither analysts nor management themselves have visibility on 2020 earnings. If you make an adjustment for what true earnings could be in the near term, that PE goes right back up to 19. And so where does that leave us with the depth and the duration of the recession, the restart, the potential recovery? And I'm going to hold out a view which suggests the following. We had an enormous economic shock. There could be potential knock-on and spillover effects. These two might combine along with things like greater propensity to save and less to spend. We believe that a short V-shaped recovery where everything kind of comes back to pre-crisis conditions as early as the end of this year just seems to be a less likely outcome. We would also alert our listeners that given the high level of both economic and medical uncertainty, we strongly recommend that investors stay the course. We do not recommend any asset allocation changes in fully invested portfolios. Let me continue to quickly march through. I promised you constructive outlooks over the longer term. I'm going to show you two really quick slides. In the first instance, my God, is this busy or what? So let me draw your attention to the key points. Right. What are we looking at here? We went ahead and identified the 10 worst quarters since 1950. What were S&P returns subsequent to such a quarter being registered? And in all instances but one, so all the slew of numbers that you see towards the right, each one of them is positive. There's only one negative number. It happened in the third quarter of 2001. After the negative quarter, then the subsequent one-year return was negative as well. Everything else has been positive. And actually, remarkably and spectacularly so. So, for example, the one-year return on average following a really bad quarter is 24.4%. It is higher than annualized returns over longer periods of time, but even the 10-year return is at 11.9% after a original bad quarter. So great entry point if you're a long-term investor. This chart looks busy. Let me qualify this for you. This comes to us from our good friends at Morningstar. I'm just going to take your attention to that bottom panel. You have seen this chart over and over again, but it's worth reminding ourselves that stocks have historically never generated a negative return in any rolling 15-year period. I do want to start wrapping my comments up. I thought I would switch gears, focus on portfolio strategy for just a few minutes. And we have actually been really pleased that our emphasis on high-quality, stable cash flow investments has held up well during the recent sell-off. Over the years, you've come to know how we think of investments. We look for companies with strong balance sheets, sustainable competitive advantage, and a defensible economic moat. And so I decided to showcase two of our top stock picks in this section. Amazon comes first. Here's what Amazon has done in 2020 so far. Well, sit back and think about this really unusual set of circumstances. Imagine a company that is enjoying significant secular tailwinds. Along comes a massive shock, a dislocation that disrupts everything in its wake. Except somehow, for this one company, it actually creates more demand that further strengthens its already strong secular position. Well, Amazon finds itself in this rare position. Its unique value proposition has actually been enhanced by the pandemic, which has shut down so much of the economy. This looks a bit of a gobbledygook of mixed arrows, but it really is powerful and rather intelligent. It allows us to begin by showing you the Amazon flywheel. This is their business strategy that helps them to grow and grow sustainably. So what is going on here? Amazon powers growth by using the benefits of its style to eventually enhance the customer experience. So they have scale. The scale creates a lower cost structure, which drives lower prices. I'm now moving clockwise, which improves the customer, which does the following. Now you got a more engaged customer base. That means there are more users on the platform, which means there is more traffic on the website, which attracts more sellers, creates more selection choices, and which then further enhances the customer experience. Flywheel gathers momentum, higher growth, more scale, lower cost, lower prices, happier customers, more users, more traffic, more sellers, more selection, even happier customers, and the beat goes on. That's how the flywheel continues to fly around. And so in this sell-off, what has happened? In the midst of the shutdown, consumers are relying more on delivery. Amazon over the years invested in logistics. This is now paying off because they have far better control over distribution outcomes. This, of course, improves the user experience, which, as we know, goes back and drives that flywheel even faster. What else do we know? We know a lot of shows and sports programming is on hold. Prime membership has increased in value. Customers want differentiated content. And this has allowed Amazon to monetize all the investment that they made in owned and original media. They also created this content with mobile in mind, and so that delivery of the content is even more seamless. And guess what it does? It creates a better user experience, which goes right back to that flywheel. AWS benefits from greater demand for cloud computing. Why is that? Well, a lot of people are forced to work from home. This could become the norm and create future demand. And my last comment in the next minute or two is to talk about a company. If there was ever a company that could provide insights on how consumer behavior would change because of things like we have social distancing, now we don't, what company would help us understand that? Well, it would be Nike. They have a strong brand name, and they have a distribution channel to get to each and every one of these consumers. Nike is a classic Whittier Trust stock pick, positioned for growth, valuable brand, broad distribution network, high margins, low leverage, everything that we like. But what has happened to Nike in the last few weeks? Nike is unusual in that they have a fiscal year that ends on May 31st. They announced quarterly earnings at the end of March, and this was interesting because it picked up results for the month of February coming out of China. China has about 5,000 stores. Nike has 5,000 stores in China. All of them were closed during the lockdown. So as China focuses more on omni-channel distribution, they focus more on direct to the consumer, here is the pivot that they did. They were able to shift inventories to meet surging online sales, and digital sales were up nearly 100% year over year. With those same omni-channel capabilities, they will be able to easily shift inventory back to stores once those reopen to meet up pent-up demand. They've been doing this in South Korea, in Japan, and they believe they actually have a playbook to restart the global economy, each plan customized to each country. I probably went a few minutes longer than I might have liked. I'm going to pause my comments, wrap up my presentation on this investment and market outlook.
Thank you. This does conclude today's webinar. We thank you for your participation. You may disconnect your lines at this time and have a wonderful day.